This video is for FIN 1011, Fundamentals of Financial Planning, and the topic of this video today is chapters 14, 15, 16, Stocks, Bonds, and Mutual Funds. So before we jump into the video, I just want to do a quick review of what are some of the areas of financial planning. 1, financial management. 2, insurance and risk management. 3, investment planning. That's really the focus for the video today. Retirement planning, tax planning, and estate planning. I also want to just take the brief period of time to review the course learning objectives and where we are at right now and what we've got left. The first course learning objective is to identify ethics and fundamentals of financial planning. So there are 3 objectives. Number 1, explain and define the concept of financial planning, ethical principles and rules. Number 2, list and describe the 6-step financial planning process. And then there was some work that we did with regards to the time value money. So remember, there are 8 principles to the Code of Ethics, and there was a mnemonic, ICFP, eat cold cod. And so the 8 principles of the Code of Ethics: number 1, client first; number 2, integrity; number 3, competence; number 4, fairness; number 5, professionalism; number 6, confidentiality; number 7, objectivity; and number 8, diligence. And again, just a quick review. The Financial Planners Standards Council has developed a 6-step financial planning process used by certified financial planners. And the 6 steps are: number 1, establish the client planner engagement; number 2, determine goals and expectations; number 3, clarify your present financial status and identify any problem areas and opportunities; number 4, develop and present the financial plan; number 5, implement the financial plan; and finally, number 6, monitor the financial plan. The second course learning outcome is to analyze money and debt management principles, and there's 2 objectives: discuss key financial ratios and statements, and 2, identify strategies to improve financial condition. So that's falling under the area of financial management. That's looking at a family's income statement, cash flows, and their balance sheet. Assets minus liabilities equals net worth. The income statement is all the sources of income and expenses. You can't invest unless you can save money. So this course learning outcome, financial management, is basically about families budgeting. Then the next 2 course learning outcomes moved into tax and then risk management products and services. Now it's important to note that tax planning really runs through financial management, insurance and risk management, investment planning, retirement planning, and estate planning. So really tax is a thing that flows all the way through all the different areas of financial planning. And with regards to the risk management products and services, we're really talking about insurance and risk management in that area. The topic for the video today is course learning outcome 5, which is describe the various elements of investment planning. So list and define types of investments and products, discuss investment risk and solutions, and explain investment strategies and diversification. After that, the course is going to move into retirement and education planning, and finally the course will finish with estate planning, and that's going to cover the 6 areas of financial planning. So as I mentioned, the course is going to finish with course learning outcome 7, which is describing estate planning, and that's included in that is going to be describing wills, trusts, and POA means power of attorney. So now we're really jumping into the content for this video, and we're starting with chapter 14, investing in stocks. And the objectives from the notes for the chapter 14 is to discuss risk-reward trade-off, discuss the principle of diversification, discuss the concept of the efficient market hypothesis, identify the most important features of stocks and preferred stocks, evaluate stock investments, understand how stocks are bought and sold, and understand long and short-term trading techniques. Now, if you're not so familiar with stocks, then there's a supplementary reading, which means an extra reading that I highly recommend, and it's from the CFA Institute Investment Foundations program. They have a chapter with regards to equities. I just want to show you very quickly the supplementary reading that I'm recommending. It's CFA Institute Investment Foundations program, and so I have opened up here the chapter on equities, And it starts with just a little bit of a blurb on the Investment Foundations program. And then you can see Chapter 10 is the topic is equity securities. Equities is stocks or shares. It's different words meaning the same thing. And if I scroll down, the learning outcomes for that chapter is to describe features of equity securities, describe types of equity securities. That's like common shares and preferred shares. Gets into a little bit of extra content that's beyond the scope of our course. Compare risk and return of equity and debt securities. That's really important with regards to investment planning. Understanding who issues debt securities, governments and corporations. Who issues equity securities, corporations. Why they issue them, and why investors would want to buy bonds or stocks. Another learning outcome is describe approaches to valuing common shares. We do that a little bit in FIN 1003, which is Financial Systems in Canada. So you might have had some familiarity with that because it is covered in one of the chapters, the dividend discount model. And another learning outcome in this chapter is describe company actions that affect company shares outstanding. So this chapter's only 26 pages. Again, if you're not so familiar with investing in stocks and you want a supplementary reading, then I highly recommend the CFA Institute Investment Foundations program. All these readings are free to download from the CFA Institute website. I'm just taking a quick screen grab of the CFA Institute website. It's www.cfainstitute.org. But if you just Google search CFA Institute Investment Foundations Program, you'll find the link to this page. And if I just scroll down here a little bit to show you, the CFA Investment Foundations Program covers the essentials of finance, ethics, and investment roles, providing a clear understanding of the global investment industry. This zero cost, that means free, online learning experience is designed for anyone who wants to enter or advance within the investment management industry, including IT, operations, accounting, administration, and marketing. There's no education or experience requirement, and the online exam is offered at test centers around the world. That's changing in February 2014. Anyone with access to an internet connection will be able to do the test themselves from their own computer using the internet by pledging a declaration that they didn't use their notes to study. So if I scroll down a little bit more here, you can see download the chapters from the curriculum for free. You can register for the Investment Foundations program. And so again, if I just click on that, and you can see here's the modules and the chapters. And what I'm saying is that Module 4, Investment Instruments, the Chapter 10 on Equity Securities Stocks is a very good one, 26 pages. Chapter 9 on Debt Securities is also a very good one if you're not so familiar with bonds, okay? So now we're going to discuss the risk-reward trade-off. So what we're looking at here, this data comes from Ibbotson SBBI Yearbook, if you Google search that. That's basically, they are been providing data on the returns to stocks, bonds, T-bills, and what the rate of inflation is from 1926, and I have this to 2012. I haven't updated a little bit in a while, but the numbers in the story is basically going to be the same thing. And what is it telling us? It's telling us that in general, on average, from 1926 to 2012, inflation has been running at about 3%, okay? And the annual average return on Treasury bills, that would be U.S. Treasury bills, is about 3.6%. So governments issue Treasury bills and they're bought by investors, and basically you can see the motivation is that they're very low risk. We might call them no risk because they're issued by the government, who has the ability to tax and also to print money. And so governments issue Treasury bills to borrow money, and investors buy them when they want a rate of return just a little bit higher than the rate of inflation. So you can see that would be protecting their capital. Next, we're looking at government bonds here, and the annual average, compounded annual average growth rate is about 5.7%, so a little bit higher than the Treasury bills. And governments and companies issue bonds to borrow money, to raise capital. needs to be paid back by coupon payments, interest payments, and principal returned on the maturity of the bond. Next, we're looking at stocks, and they've broken it into two categories here. Large stocks, and I'm just going to round that. Long-term on average, has stocks have had large stocks have had a return of around 10%, and small stocks. And what do they mean by large stocks and small stocks? They're talking about market capitalization. So market capitalization is the number of shares outstanding times the stock price. Okay, so large company, the largest company in the world for a while was Apple. They said it was $1 trillion company. And when you hear that statistic, they're talking about the number of shares of Apple issued and outstanding times the stock price of Apple. Okay. In Canada, the largest company by market capitalization is the Royal Bank. Anyhow, jumping back to the returns, you can see that large stocks had a return in general on average about 10%, and small stocks a little bit higher, around 11.9%. So that last slide was giving us some historical data with regards to the returns, but that's only half the equation. We also need to look at risk. So when we're looking at risk of financial investments, we typically measure the investment standard deviation, which is the square root of the variance. And you can see here is if I was to plot this on a graph, where here I have risk, which is standard deviation, and here I have return, it's basically an upward sloping curve. So small cap stocks have got the highest return, but you can see here in terms of standard deviation, they also have the highest risk or the highest variability in pricing. Okay, large cap stocks a little bit lower, 9.8%, and a little bit lower in terms of the risk, in terms of standard deviation. Okay, so it's just important to remember that we can graph not only the returns but also the risk with regards to different investments, and it's an upward sloping curve. There's a trade-off between return and risk, or risk to return. Okay, so we were just looking at some historical returns, but I just want to look quickly, how do we calculate the rate of return on a stock investment? So let's just read this little blurb here. Returns on share investments come in two forms: a capital gain portion and an income portion. The most common income portion would be a company issued dividend. So dividends are income. The capital gain is the profit made, defined as the difference between the purchase price and the selling price. So if I buy a stock for $10 and I sell it for $12, I've made $2 per share. Okay, and so we can calculate the return on that. That would be 12 minus 10 divided by 10. Ending price minus beginning price divided by beginning price. That's how we calculate the return on anything. At the time of the sale, the profit was referred to as the holding period return. So here we have the holding period return, and you can see it's P1 minus P0, or P0, plus D over P0. So what is P0? That's the price at the beginning of the holding period, so beginning. P1 is the price at the end of the holding period, end. And D is the income received, income or dividend, during the holding period. So I just like to remind you that it's ending minus beginning plus the dividend divided by the beginning price. Okay, that's how we calculate the holding period return. It's fairly simple. So again, if I just did a quick example, if the ending price was $12 and the beginning price was $10, it would be 12 minus 10 over 10. That equals 2 over 10, and that's going to be a 20% return. Now, if there's a $1 dividend that was paid during that holding period, then the formula would be 12 minus 10 plus the $1 dividend divided by the beginning price of 10, which would equal 3 over 10, and so holding period return would be 30%. Okay? In summary, holding period return, ending price minus beginning price plus the dividend divided by the beginning price. And here's another little example. John bought a stock for $20. A year later, he sold it for $25. And during the year, he received $1 in dividends. So the rate of return is 30%. Ending price 25 minus beginning price 20 plus the $1 dividend divided by 20. And that gives us 30%. 25 minus 20. I'll just bring up the calculator and prove that to you. Okay, so I've got the calculator open. 25 is the ending price, minus 20, the beginning price, plus the $1 dividend. And we're going to divide it by the beginning price of 20, and that's going to equal a 30% return, 0.3. Okay? Okay, continuing with the theme of why an investor would want to buy some stocks, we're just going to look at the S&P 500 index. An index is basically an average of a selection of stocks, their average price performance. So it gives us insight to movement and trends. Is the market going up? Is the market going down on average? And the S&P 500 is 500 of the largest companies listed in the United States. So here we can see some historical data going back from 1997 until basically the fall, September 30th, 2018. And you can see, back in 2008, the index level was at 1565, okay, on October the 9th, 2007, actually, just before the beginning of 2008. And you can see peak to trough, the market dropped by March 9th, 2009 to an index level of 677, okay? So that was a drop of 57%. So I'm just going to bring up the calculator again to show you the return on the market by using that same formula. So the ending, holding period return here from October 9th, 2007 to March 9th, 2009, the ending index level is 677. So ending 677 minus the beginning 1565 divided by the beginning level 1565. Here we're not including any dividends, and you can see it's negative 0.56741. So if we multiply that by 100, we get a nice round number, negative 56.7%. So they've rounded it there. There's our negative 57% holding period return when the index level S&P 500 was at 1565, October 9th, 2007. It dropped to 677 index level, March 9th, 2009, ending minus beginning divided by beginning, negative 57%. So you can see now the S&P 500 at the end of September 2018, 2914. So what we can see from this chart basically is that there's been periods of very strong returns from the trough here to the peak. We're looking at a 331% return, but there's also tremendous volatility, which means the prices have gone up, they've gone down, they've gone up, they've gone down. That's the risk, the volatility. If you're in a situation where you bought at a higher level and you have to sell, then you would have a recognized loss. Now remember, if you're buying and holding for a long time, yes, stock prices go up and down. When they're down, you may have a loss, but it's an unrecognized loss or a paper loss unless you sell the stock. And if you hold on long enough, perhaps, I don't know about individual stocks, but the index itself is very likely going to come back after a period of time. Okay, they say a picture is worth 1,000 words, and what we're looking at this slide is just a graph of the annual returns of the S&P 500, so that's a calendar year from January 1st to December 31st. It's not peak to trough or trough to peak. And this data is from 1970 to 2016. It's including dividends, so we would call that the total return. And the source, I put this graph together, it's from Damodaran, who works at Stern, New York University. Okay, so basically what this is showing in terms of annual returns in terms of a calendar year, that there's quite a bit of variability in the returns of the S&P 500. So going back again to the 2008 crash, we can see here that cumulatively, recall the peak to trough was negative 57%, but that was from 2007 October into the beginning of 2009. But if we look at the calendar year of 2008 in terms of a calendar year, we have a negative return of pretty close to 40%. Okay, so what this graph is telling us that it's very common on an annual calendar year for the stock market to have negative returns, which means at the end of the year, if you're invested in an index fund that's replicating the performance of the S&P 500, that very often, fairly frequently, you've got at the end of the year less money in your account than you had at the beginning of the year. That's the volatility with regards to stocks. Okay, so what this chart is showing us, and the source is from the JP Morgan. If you Google search JP Morgan Guide to the Markets, you'll find a PDF document that you can find for free on the internet, and this is where I got the source. And so the green bar is looking at stocks. That's represented by the S&P 500. The blue bar is looking at government bonds, and the gray bar is a 50-50 portfolio. So if we look at a piece of a pie, half the pie is in stocks, half the pie is in bonds, okay? That's a 50-50 portfolio of stocks and bonds. And so what are these bars showing us? That, it's giving us some time horizons here: 1 year, 5 year, 10 year, and 20 year rolling averages. So on a 1 year rolling average, you can see that the maximum loss on a calendar year is that negative 39%, and that's the S&P 500. We saw that. That was in 2008, okay? And the maximum positive return on the S&P 500 in 1 year, calendar year, from January 1st to December 31st, could be 47%. And that's what we saw in the previous slide with the graph. That's the top of the returns, and that would be the bottom, and that we saw that's the variability. So there's less variability in bonds, and we saw that with regards to bond returns, lower returns and lower volatility. We saw that. And so if we combine a portfolio that's 50% in stocks and 50% in bonds, you would have a negative return no worse than negative 15% and a positive return no better than 33%. And so you can see that's considerably less variability having a diversified portfolio in stocks and bonds than owning only stocks, okay? And that's the lesson on diversification, that if we split up our asset allocation between stocks and bonds and maybe another percentage in cash, we're creating a portfolio, okay? And a portfolio, in this case, 50-50 between stocks and bonds, is going to have a lot less variability in returns, or less volatility, than an all-stock portfolio. And the next lesson that we learned, that as you can see, yes, there are negative returns, but over time, there's more positive returns than the stock market than negative. So the longer you hold on, the rolling average gets better and better for stocks. And in fact, in the past, 2008 was such a bad crash. If you look here at the 10-year rolling average, the return maximum for 100% in stocks, about 19%, and the negative return, negative 1%, okay? But if we get moved to 20 years, there's really no chance of having a negative result from owning 100% in stocks. It's all positive, okay? The negative in this case, rolling average, is 7% over 20 years. So the longer your time horizon, the less chance of a loss with regards to owning stock. And that's why you hear the expression sometimes to buy and hold on. Okay, this next slide is looking at 6 asset allocation profiles. And this is from RBC Dominion Securities, actually. This is 6 of their portfolios. And you can see, again, if we call this a piece of pie, the asset allocation is breaking up the pie between a piece of for fixed income and cash, and a piece for equities, which is stocks, okay? And again, on this axis, it's measuring the return. Higher on the axis means higher return. And on this axis, we're measuring risk, which, as we said, we use it by measuring standard deviation, which is the square root of variance, okay? And as we can see that as we increase our expected or required return, we're also increasing the risk, and we saw that from the historical return and risk data. So when we look at different asset allocation profiles, different ways of cutting up the pie, if we look at the secure portfolio, then it's really made up of a large percentage of fixed income. That's that lower volatility, less chance of return. And as we move out to growing our capital, it's done through having a very big piece of the pie invested in equities, stocks, okay? And somewhere in here in between would be a balanced portfolio that might be 70% in stocks and 30% in bonds, something like that. So the 6 asset allocation profiles for RBC starts at secure, moves up to income, to conservative, to balance, to growth, to aggressive growth. And basically what we're doing from each stage is reducing the amount invested in bonds and increasing the amount that is invested in stocks. Okay, and that's basically a portfolio. The previous slide we looked at the 50-50 stock bond portfolio. This is looking at different percentages. As I said, the balanced portfolio might be 70% in stocks, 30% in bonds, and the aggressive growth portfolio might be 95% in stocks and only 5% in bonds. What this next slide is showing is that it comes from the sources Barclays. If you was to Google search Barclays average investor emotions can affect investment returns, you'd find a white paper. Included in that white paper would be this graph. And what that's saying is we've seen with the stock market there's variability with regards to the returns, and that can also that variability in returns can affect investors' behavior. When the stock market is very high, we're at a high level of emotion here, exuberance, and people are buying. But as the market can drop, and we can see it can drop substantially, peak to trough of the S&P 500, 2007 to 2009, down 57%. So imagine if you had an S&P 500 index fund that at the beginning, at the peak, was worth $100,000. When you got down to the trough in 2009, your account would have roughly $43,000, okay, not including dividends. That's a drop of 57%. When that happens, that can send some people into fear, desperation, panic, capitulation, despondency, and depression, and they sell, okay? Of course, with regards to stocks, you want to buy low and sell high. That's how we make money. Ending minus beginning divided by beginning. Buy low, sell high. But in fact, average investors, their emotions can get in the way. They're buying when the stock market is roaring up. It seems like a great idea. There's a correction. People get despondent and they start to sell. So they're doing the exact opposite. They're buying high and selling low, and they're losing money. So I always like to include a couple of quotes from Benjamin Graham. He wrote a very famous book called The Intelligent Investor. I'm not going to read the whole slide, but Benjamin Graham stated that every investor who owns common stocks must expect to see them fluctuate in value over the years. And we saw that, the performance of the S&P 500. And so what he's saying is that ultimately financial risk resides not in what kind of investments that you have, but in what kind of investor you are. So that's relating to the average investor's emotions. If you can't control your emotions and you're buying high and selling low, then the risk isn't in the investments. Yes, stocks go up and they go down. Bond prices go up, they go down. There's risks in all financial assets, but the risk that you need to manage is your personal risk, how you react to the swings in the market. And so it says here that success comes from harnessing our emotions and understanding the things we can control and we cannot control. Now, as future financial planners, your job is to educate your clients with regards to the trends and cycles in history. And so if an investor's objective is to grow their wealth, to increase their capital, and you recommend investing in stocks, they need to realize that there's potentially good returns, but also not only good returns, but also there's volatility along the way, okay? So I'm not going to read this whole slide, but again, it's just a couple of quotes from another legendary investor named Jack Bogle. And his message is stick to simplicity. Don't complicate the process. Basic investing is simple, a sensible asset allocation to stocks, bonds, and cash. Perhaps the most critical decision you face is getting the proper allocation of your assets into your investment portfolio. There's different strokes for different folks. We have different willingnesses and abilities to take on risk. So for some individuals and families, the proper allocation of assets might be very secure, where another individual or family, the proper allocation of assets might be much more aggressive growth, okay? Stocks are designed to provide growth of capital and growth of income through dividends, while bonds are for conservation of capital and current income. And we've seen that through the risk and return historical figures. Once you get your balance right, then just hold tight, no matter how high a greedy stock market flies, nor how low a frightened market plunges. So that's saying, buy whenever you're buying, just don't buy high and sell low, okay? and change the allocation only as your investment profile changes. And so finally here, the paradox is that in these times of increasing complexity, simplicity underlies the best investment strategy. So a very simple investment strategy is having a proper allocation between stocks, bonds, and cash. And we can simplify the security selection in terms of stocks and bonds into products that replicate an index. Okay, and that way we're getting diversification and we're getting simplicity. Okay, a few of those last few slides were my own content to complement the course, but now we're back into investing in stocks, and this is straight out of the notes that are posted on Blackboard. And so these next two slides, we're looking at classifications of stock investments, and there are 8 general classifications of stocks. Number 1 is blue chip stocks. These are the strongest and most respected companies, such as Bell Canada, Royal Bank. Second classification is income stocks. These stocks pay higher than average dividends. And we can look at the Toronto market and pick out some, do a sort and pick out some of the companies that pay higher than average dividends. That's easy to do. Another classification is growth stocks. These are in general more risky than the stocks listed above, but have the potential to earn profits in excess of that of the market indexes. So growth stocks are typically, a good example would be technology companies. And in general, on average, growth stocks do not pay dividends because they're growing so much, they're retaining their earnings and reinvesting them into the company. Okay. So carrying on with our 8 classifications of stock investments, number 4 is cyclical stocks. Cyclical stocks tend to move in step with the economy, expanding as the economy grows and shrinking as the economy slows. So automobiles, paper, steel companies are examples. Number 5, defensive stocks are those that remain stable in poor economic conditions. Food and utility companies are examples. And now we get into classification of stock investments based on market capitalization. And we've seen this already. Large cap stocks are issued by companies with a large capitalization and therefore lots of shareholders. So that's the number of shares outstanding times the share price. And a small cap stock are issued by companies with less than 150 in terms of market cap, 150 million in terms of market capitalization. Finally, a last classification of stock investments is penny stocks. These trade for less than $1. They're very risky. Penny stocks are not listed on exchange. They're traded over the counter. Okay, the next thing that we're going to look at is preferred shares. So we've talked a little bit about common shares, which give, and most of our students have basic familiarity with common shares. They give the investor the right to vote. They give the investor a dividend, which is declared by the company and it's not guaranteed. But if we look at preferred shares, a preferred share is often referred to as a middle investment, somewhere between a stock and a bond. The reason is because the preferred share is priced upon the dividend that it pays. Preferred shares are going to pay a dividend that doesn't change over time. Okay, the company agrees to pay the dividend. It can miss payment without creditors having the ability to demand immediate collection. So that's why it's better than a bond from the company's point of view. If they don't make that preferred dividend payment, there's no economic default. Okay. And the board of directors of the company makes the decision whether or not to pay the dividend. So some preferred shares are called cumulative, which means if the preferred share dividend is not paid, then the company cannot pay any dividends to common shareholders until all the preferred share holders are paid up, like they pay the missing dividend, then they pay the next dividend. So that means it's a cumulative dividend. Non-cumulative means that if the preferred share dividend is not paid, the company does not have to pay it back to the preferred shareholder, and they can continue paying dividends to common shareholders. Okay, so preferred shares, in general, on average, pay have a fairly good yield because they're a little bit riskier than bonds. So they provide some decent income. And again, we could look at the listing of preferred shares on the Toronto stock market to look at what the indicative yields are and who the companies are that issuing them. In general, on average, the banks have all issued preferred shares. Investors like them because they provide some income, and they get issued by companies because it's an avenue to raise capital. Another objective in Chapter 14 on investing in stocks is to understand how stocks are bought and sold, and the notes include 3 types of orders that are used to place trades. Number 1 is the market order. It's an order to buy or sell the stock at the current market price. A limit order is a request to buy or sell a stock at a specified price, and a discretionary order is a buy or sell order when you've given the stockbroker the authorization for them to buy or sell as they seem fit. Okay. Another objective in Chapter 14, investing in stocks, is to understand long-term and short-term trading techniques. So this slide is looking at 4 long-term trading techniques, and I'm not going to read it all, but number 1 is buy and hold technique. Number 2 is dollar cost averaging. Number 3 is a direct investment program. I'll just mention that one. A direct investment is where an investor can purchase stock directly from the company without using a broker. That's fairly rare. Most transactions for most individuals is through some type of a broker. And finally, number 4, dividend reinvestment plan. This is very important, is a plan where instead of a cash dividend, the dividend is used to purchase additional shares. Okay, and there's no commission charged and a broker is not required. Okay, I'm going to use this graph, and it's from Index Fund Advisors website, and I'm going to illustrate a couple of key points. And so the title of the graph is Emotions of Passive Investors. Okay, so that brings us up to 2 different philosophies. On the one hand, we have an active investment philosophy, and when we mean active, we are talking in terms of security selection. And that could be industry or individual securities. So you're actively trying to choose different sectors, different securities, even different assets between the allocation between stocks and bonds. The other way that we can be active in terms of our market timing. And so we expect that the market is going to drop, so we might sell some of our holdings. When we think the market is going to continue to rise, so we continue to buy. Again, in summary, active investing is looking at being actively choosing individual securities and trying to time the market. On the other hand, we have a philosophy of passive investing, a passive investor, and that's really the buy and hold strategy. Okay, and that's what this graph is showing, is the emotions of a passive investor. They're buying at different times of the market. The market's going up, it's going down, but in general, on average, they're continuing to invest their savings in the market. They're not trying to time the market and not trying to choose individual securities. So that also brings up the topic of dollar cost averaging. Dollar cost averaging is looking at what price did you buy here, what price did you buy here, what price did you buy here, and how much did you spend, and we can work out the weighted average cost of the number of shares that you've bought. Okay, so that brings up the concept of dollar cost averaging, and in terms of buy and hold or passive investing, means that you have a longer time horizon and you're continuing a program of investing your savings. So another objective in the chapter is to understand long-term and short-term trading techniques. Now, I'm not going to read all this. You've got the notes. I just want to point out that the short-term trading techniques regularly used, buying on margin, that's where you borrow money for the purchase of particular stocks. The broker or the bank is going to lend you money, so that can be fairly risky because that involves some financial leverage. And if the market goes down on borrowed funds, you can run into a little bit of a problem. Another short-term trading technique is selling short. That's when you feel that a stock is going to fall, so you can sell something that you don't actually own. And in this case, you want to sell high and buy low, and that's how you make money. And note that the New York Stock Exchange and Toronto Stock Exchange have an uptick rule. That means if the market is really going down and crashing, you just can't jump in and sell. To be able to do a short sell, it has to be on the previous trade there has to be an increase in the stock price. Okay, and another short-term technique is trading on options. An option gives the purchaser the right to buy or sell a stock at a specific price, but not the obligation. Okay, that's trading on options is a little bit beyond the scope of most retail investors and beyond the scope of this course. Another important topic that is covered in the notes for Chapter 14 is what is a stock index. We've talked about the TSX Index and we've looked at some data for the S&P 500. So I just want to make sure everyone understands that a stock index is a sampling in many cases of a smaller section of the entire stock exchange. So in Toronto, there's 247 companies that is included in the S&P TSX Composite Index. And you can see that comprises 70% of the exchange capitalization. There's 247 companies in the index, but there's many more companies that are actually listed on the stock exchange. The index is just a sampling, and that gives us, by measuring the index, we get some indication of which way the general market is moving. Some other examples of very big and famous stock market indexes is the New York Stock Exchange Composite Index, the Dow Jones Industrial Average, the NASDAQ Composite Index, which lists mostly technology stocks, and finally the Standard & Poor's 500. We call that the S&P 500. It contains the largest 500 companies listed on the New York Stock Exchange, and it's the best benchmark in the world for large cap stocks because the US market is so huge, and that's why we often use the S&P 500 as a proxy when we talk about the market, the stock market. We use the S&P 500 as a proxy for the market. This slide is just showing a chart of the S&P TSX Composite Index. So we can see on November the 13th at around 10:53 a.m., the TSX, the index was at 15,168. Okay, so this is showing back, you can see before 2005, the market was, the TSX was strongly rising in general on average, although we can see there's volatility in shorter time periods. But here's the crisis in 2008, 2009. So similar to the S&P 500, the TSX also dropped dramatically, and over the years has increased, another small decrease, increase, decrease. So that's the volatility that we see. And here on the right-hand axis, we've got the index level. So in November 2018, on November the 13th, in the middle of the day, the index is at 15,168. Okay, on this slide, it's also the S&P TSX Composite Index. So you can see right here, that's the 15,100 and change. But I've zoomed in from the beginning of 2017 until today's date. And I've added this blue line, and SMA means a simple moving average, and it's a 200-day moving average. That's why the 200 is in the brackets, okay? And so we're not going to talk about different trading strategies, but if you hear about people that are into technical trading, then they're using a lot of charts. And most people don't really do that, especially if you're following a passive strategy of buy and hold. You're not actively trading, trying to time the market and using charts. But I just wanted to show you that a good long-term indicator of where the market is headed is by using the 200-day moving average. So when the stock market index breaks from below to above the 200-day moving average line, that's a buy signal. And if the market drops from above to below the 200-day moving average line, that's a sell signal. So you can see in the most recent days and weeks, the market has been dropping down. So if I had fresh money to invest, perhaps I've just came into some savings, I may want to wait and rather than invest directly in the stock market index, if I was using the belief that because the market had moved from above to below the 200 moving day average, that is a sell sign, I would wait until that the index breaks back above, and that would be my buy signal. Okay, so I don't want to spend too much time on that, but I just wanted to show you that when we zoom in on shorter and shorter time periods with regards to an index or a market, we can look at moving averages, and that gives us some indication of the longer trend, which way the market is moving. And this is the last slide with regards to stocks. And again, this is my own slide. It's not exactly in the course content, but I just wanted to make sure that people understood not only stocks, but also the indexes. So if we look at the S&P TSX Index, as I mentioned, there's 247 companies included in the index. And if we look at in terms of market capitalization, we've got some sectors here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These are 10 sectors. And we can see that the largest sector in terms of by market capitalization in terms of weight is the financials. So what do we see here? Royal Bank of Canada is the largest company in Canada by market capitalization, followed by TD, followed by Bank of Nova Scotia. So you can see the banks are the biggest and companies in Canada with regards to market capitalization. Down here you've got Bank of Montreal, and CIBC will be a little bit lower. Okay, Toronto market after the financials is the energy, and that the big companies in the energy sector. Enbridge is a pipeline company. You've got Suncor Energy, which is involved in the oil sands out west, and you've got transportation here. Canadian CNR is a fairly large company as well. Okay, so I just wanted to end the section on investing in stocks with this slide on the S&P TSX, and again that's Standard & Poor's. You've got the S&P 500. That's just the company that maintains the index. Okay, so we've got the TSX for Canada, and you can see that 10 sectors, most heavily dominated by financial companies. Okay, now we're moving into chapter 15, and this is the chapter on bonds, and the objectives are to understand characteristics of corporate bonds, understand why corporations issue bonds and investors purchase corporate bonds, and understand federal, provincial, and municipal bonds and why investors purchase these items. And finally, learn to evaluate bonds when making an investment. Now, don't worry, the section on equities and leading up to this chapter was about 40 minutes. This is not going to be as long. It's going to be just a brief kind of overview. And again, if you are someone that is not so familiar with bonds and wants to do an extra supplementary reading, then I highly recommend the CFA Institute Investment Foundations program and the chapter on debt securities, which includes information with regards to bonds. So again, I just want to remind you, the CFA Institute Investment Foundations, Chapter 9 on debt securities. Again, it's only 26 pages, so I'm just opening up the chapter right here that you can download for free, Chapter 9, Debt Securities. And if we scroll down and we look at the learning outcomes for this chapter, we can see that you should be able to identify issuers of debt securities, so that's governments and corporations, describe features of debt securities, describe seniority ranking, etc. Again, supplementary reading if you want to read up more about bonds, and I highly encourage you to do the CFA Institute Investment Foundations program. It's free. You can earn the certificate, 20 chapters. One of the chapters is on debt, so why not read this chapter while you're studying the topic at college to help complement your understanding. This slide is straight out of the notes, Chapter 15, Investing on Bonds, and we're looking at characteristics of corporate bonds. So corporations issue bonds. They want to borrow money, and so they're making a pledge to repay a specific amount of money and interest as stated at the time of the bond. The face value is the amount of money the bondholder will receive when the bond matures. From the date of purchase, the corporation will pay interest to the bondholder, usually every 6 months. We call that semi-annually. And the stated rate at the time of the bond's purchase is called the coupon rate. Okay, the coupon rate never changes, but interest rates go up and interest rates go down, and so the price of a bond will change. Okay, as interest rates go up, the price of the bond will go down. If interest rates go down, the price of the bond is going to go up. Okay, so here's an example. It's a purchase a $1,000 face value bond that pays 6.5% interest, coupon interest. So therefore, the formula is the dollar amount of annual interest equals the face value times the interest rate, coupon rate. 1,000 times 6.5% equals $65. And if interest is paid semi-annually, then each payment would be 65 divided by 2 equals $32.50. Continuing from the notes, why investors purchase corporate bonds. Bonds over the long term have given returns that are less than investments in stocks, and we saw that through our historical returns and our historical volatilities or risk. Investors will settle in some cases for a lower expected return as bonds are seen as a safe investment, especially if held to maturity, and also helps investors diversify their portfolios which I showed you, the maximum return annually and maximum loss for stocks, bonds in a 50-50 portfolio. So now we're starting to understand why investors purchase bonds and why we construct portfolios that are made up of some allocation between stocks and bonds. Okay, carrying on now. Investors have three main reasons for purchasing bonds, and I'm not going to read it all to you. It is in the notes. The first reason is for that interest income. Bondholders usually receive interest income annually, so I'm going to buy a bond if I have a requirement to increase my income throughout the year. Okay. A second reason might be dollar appreciation of the bond. Now that the price of bonds, contrary to what most people think, does fluctuate. The coupon never changes. That coupon payment never changes, but the price of a bond does change. Overall interest rates in the market are the main cause of price changes, and bond prices are inversely correlated to the change in interest rates. I said that inversely correlated means if interest rates increase, the bond price goes down. And that's just a simple function of math, because the price of a bond is the present value of the future coupon payments and the present value of the face value or par value being paid back to you on maturity. Okay. And the third reason why investors purchase corporate bonds would be to get that repayment at maturity. At maturity date, the face amount of the bond is paid back. Okay, there's a couple of things that we can use the financial calculator to calculate with regards to bonds. One is calculating the yield to maturity on a bond, because as we said, the price changes as interest rates go up and interest rates go down. So if I'm buying a bond, not say at $1,000 at the face value, the par value, I need to calculate what my yield would be. The other thing that we can calculate is if we know the yield, we can calculate what the price is. Okay. So first we're going to look at calculating the yield to maturity on a bond, and we're going to work through this example. The yield to maturity takes into account the relationship between the bond's maturity value, time to maturity, the current price, and the dollar amount of interest. So in this example, on January 1st, 2007, you purchase a corporate bond with a market price of $860. So that's less than the face value of $1,000, and it's going to pay a 7% annual coupon interest. And again, that doesn't change. The coupon interest does not change, and the maturity date is 2023. So how do we calculate the yield? We're going to bring up the financial calculator, and the first thing, n equals 17 years, because you're buying at the beginning of 2007 and it's maturing in 2023. So if we do 2023 minus 2007, we always have to add 1. Nevertheless, we're going to check our PY as well. So PY is set as 1. This is not a semi-annual payment because 7% annual interest, and we're making the payment at 70. So that's, and it's saying right here, annual interest, it's not semi-annual. So we're going to check second PY, periods per year equals 1. So we've got the calculator set up properly. So this is our time value of money functionality, which we've used previously in the course. So it's going to be 17N. Present value is the price of the bond, and that is a negative because we're going to put $860 out of our pocket to get the coupon payment and to get the future value, face value back on maturity. So the present value is negative $860. The payment is going to be the face value, 1,000 times that 7% times 0.07, which gives us our 70, and that's money coming into us, so it's a positive, that's a payment. And finally, the face value, future value, is the 1,000. That's also sometimes called the par value. So we can hit compute IY, and we've got the yield of 8.596%. So that's how we calculate the yield. Time value of money, we're putting in N for the number of years or number of periods. The present value is the price of the bond. The payment is each coupon payment, and the face value, future value is the face value or par value, and we compute for IY, and that gives us our yield to maturity on the bond. Okay, this isn't exactly in the notes, but I just want to make sure that we covered calculating the price of the bond, and this should be covered in FIN 1003, Financial Systems in Canada. You may recall in Chapter 4 was looking at interest rates, and it was looking at not only interest in terms of the coupon payments, but also returns. And so we did that by calculating the price of the bond at some time in the future, and we looked at ending minus beginning divided by beginning, and we've got the capital gain or loss. So this, you may recall, should have probably been covered in FIN 1003. Nevertheless, I'm going to stick with the same example. January 1st, 2007, you purchase a corporate bond with a face value of $1,000. It pays 7% annual interest, and the maturity date is 2023. But in this case, I'm saying the yield on the bond is 8%. What is the price? And then I'm going to show if the yield on the bond was 5%, what is the price? So we're going to bring up the financial calculator again. That was our IOI from the previous example. Of course, we've got the calculator set for PY equals 1, which is the annual. So again, we're going to put 17 is the N. And in this case, it's saying if the yield is 8%, what is the price? So 8 is the IOI, and the price is going to be the present value. That's what we're going to compute for. And we know the coupon payment annually is $70, and the face value is $1,000, future value. So we're going to compute the present value. We could see that the price of the bond to get an 8% yield with a 7% coupon over 17 years would be $908. 908 is less than 1,000. Yes, because it's 8% yield with a 7% coupon, so I need to be able to buy the bond at a discount. Now again, the second part of the question says if the yield on the bond was 5%, if interest rates go down, what would be the price on of the bond? Now you can see the yield is going to be 5%, but it's paying a 7% coupon, so you'll probably figure out that the price is going to be greater than 1,000. So again, just working through 17N. In this case, we're doing 5 IOI, and the payment is the same, 70 payment, future value 1,000. Going to compute the price, present value 1,225. So if I paid 1,225.48 on January 1st, 2007, received $70 a year for 17 years, and then 1,000 at the when the bond matures, I would have a yield of 5%. Okay, so if the yield is less than the coupon rate, the bond is being sold at a premium. And if the yield is more than the coupon rate, the bond is being sold at a discount. So that's very quickly the last two slides, how to calculate the yield to maturity on a bond, given certain information, and how to calculate the present value or the price of a bond when you're given the yield. Okay, so that concluded the section on bonds. As I said, we're covering chapters 14, 15, 16, stocks, bonds, and mutual funds. There is some more information contained in the notes. I just wanted to make sure that we covered some of the major topics. Okay, so now we're bashing forward on investing in mutual funds. It's chapter 16. So a few key things to understand is that a mutual fund is an investment company that pools money from investors and uses professional fund managers to buy stocks, bonds, and other financial securities on behalf of those investors. Each investor is an owner of the fund in proportion to their investment and the value of the fund. The major reason why investors purchase mutual funds is to obtain professional management and diversification. Most investors do not have the time, expertise, or motivation to manage their own investments. Mutual funds will carry numerous holdings so that if one particular security falls, there are others that theoretically will realize gains that will somewhat offset any losses incurred. And so that we're talking about diversification there. If we look at individual stocks, the company might be going up or down. If we look at Research in Motion that made the BlackBerry, the stock went down to near zero. If we look at the banks, the bank stocks have been doing very well. If you start to combine them, then we look at the index. The index long-term on average has done very well. Okay, and that's the idea behind diversification. Many investors do not have enough money to buy a portfolio that has adequate diversification, so you can invest small amounts into a larger pool, larger fund, and you'll get diversification through that avenue. So again, I'm not going to cover all the points in Chapter 16 on mutual funds. This is the second to last slide, and the last slide containing information from the notes. And it just is the advantages and disadvantages of mutual funds. Anytime you see lists like this, 7 advantages and 5 disadvantages, you know that that makes up for an excellent short answer question. Okay, so I would make a flashcard for this and memorize it. Anyhow, the advantages of mutual funds: number 1, diversification; 2, professional management; 3, easy to buy and sell shares; 4, small investment is required. Many withdrawal options, number 5. Number 6, distribution or reinvestment of income and capital gains. And finally, number 7, there may be switching privileges in the same family of funds. What does that mean? It means I could change from an index fund to a stock fund to a bond fund, and without incurring any substantial or fees. Okay. Some disadvantages of mutual funds is that there are purchase and withdrawal costs. And so there's loads, there's fees, and fees and expenses is negative performance. There's potential for poor performance. Long-term on average, a lot of active fund managers don't outperform their benchmark index. For example, you might have a stock fund and the benchmark index is the S&P TSX, the Toronto Stock Exchange, and the fund manager doesn't do as well as the exchange because they've picked more losers than winners. Okay. Another disadvantage of a mutual fund is you cannot control when you're getting your capital gain or income distributions. That means the fund is doing it on your behalf. So you're buying, but in terms of the holding, you're not making those timing decisions. And finally, market risk associated with investments. But that is we've talked about that as well. Market risk, whether you're buying individual stocks on your own or mutual funds, you're going to be exposed to that market risk. And this is the last slide for this video, and I just wanted to end the chapter on mutual funds by showing an example of a special type of mutual fund. It's called an exchange traded fund. So this is a mutual fund. Normally mutual funds are only priced once a day, and if you put a buy order today, you'll just get everyone buying and selling will receive the same price. But an exchange traded fund is traded throughout the day. So that's one different example, and it's listed on the index. So that's one major difference between an ETF, an exchange traded fund, and a normal mutual fund. Another big difference is that mutual funds that are professionally managed are actively managed, and they're meant to try to outperform their benchmark index, but an ETF is meant to replicate the performance of the index. So because we've been looking at some data with regards to the S&P TSX Index, this is a fund. You can see the mutual fund company is called BlackRock. The name of the fund is the iShares Core S&P TSX Capped Composite ETF. The stock trading symbol, or the ticker symbol, is XIC. So you can look on the Toronto Stock Exchange and click in the ticker symbol XIC, and that will give you the price of this mutual fund that is an exchange traded fund. And you can see why XIC here in the bottom right hand corner. We can see that XIC is you can own the entire Canadian stock market, and it's low cost because it's replicating, it's not being actively managed. And what is the objective? Well, we know why we invest in stocks. We're seeking long-term capital growth by replicating the performance of the index, okay? And again, if we look here at the sectors, because it's replicating the index, we can see that the largest sector in the fund is financials, followed by energy, etc. This is going to be in the exact same weightings as the index. The fund allocation, dollar allocation to different sectors and different securities is going to replicate the index, okay? And if we look at the annual average returns, we can see the 10-year return for the fund, this is total return, so it's including dividends, is 7.38, and the return for the index, 7.56. The small difference here is called tracking error, okay? It's not always exact, but it's usually very close. There's a couple of different reasons why it's not going to be replicate 100%. That's just a bit of small tracking error, okay? And we could also go and look at the cumulative returns. Again, if you Google search, the name for this fund will take you to the website, and there's a lot of other information that you can download. For example, the holdings and what sector those holdings are listed in. And for me, that is the end of this video for chapter 14, 15, 16, stocks, bonds, and mutual funds. Again, there's supplementary readings that you can do from the CFA Investment Foundation's program if you want more information on stocks and bonds, and I highly encourage you to study that and to do the certificate at some point. And also, I like to bring the real world into the classroom. So if we're talking about mutual funds, let's take some time to look maybe not only at this BlackRock iShares exchange traded fund, but we can look at some mutual funds that are issued by some of the major banks. But anyhow, we can do more of that in class. For now, that is the end of this video. Thank you very much.